In a conversation with Bloomberg Quint earlier today, Sajjid Chinoy of JPMorgan explained the demand-supply dynamics in the bond markets and the impact these higher borrowing costs could have. Listen in.
You know, we have seen in the last 6 months actually this growing demand-supply mismatch in the market. The fact is supply does pick up every year, but I think on the demand side, you know, the way I think back is we can always have idiosyncratic explanations for one auction or 1 month. But let's step back and try and understand what's happening. I think what you're seeing in India's case is on the demand side, financial repression has been progressively brought down because policymakers, the RBI has been reducing the SLR ratio over the last 4 or 5 years and the hold to maturity ratio in tandem. So on the one hand, we've brought down financial repression so that, you know, banks are not captive buyers of government bonds, that credit can go to the most productive parts of the economy. But that also means that banks are subject to much more mark-to-market risk when in fact they do buy bonds because they don't have the protection of the HTM. On the other hand, we've seen that there is an understandable wariness to dramatically open up foreign portfolio investor limits, and so the general limit is full. And so even if at these levels some foreigners want to buy, there is no space for the most part. This is, you know, before the fact that you've had some outflows in the last 2 weeks. So I think on the one hand, if you want to reduce financial repression and there is no urgency to open up the capital account, then what is needed is a commensurate reduction in supply and the fiscal deficit. And the fact is, over the last 4 or 5 years, the center has done its part. It's brought its deficit down, notwithstanding the recent slippage. State deficits have moved the other way. So the consolidated deficit the last 5 years has simply come down from about 6.7% to 6.4%. So something has to give. You know, I call this kind of a fiscal trilemma, that on the one hand, if you're reducing financial repression, and the consolidated supply or deficit is not coming down in tandem, and we have limits on how much foreigners can buy, something has to give. And I think that's fundamentally what's keeping the bond market on edge. I think very quickly, just to conclude, I think next year, hopefully some of the fiscal uncertainty goes away. I think when the borrowing program comes out today, I'm sure the government's going to be more judicious about where that supply is issued, that it's issued across the curve. And one upshot here is later in the year, if credit growth remains soft, then maybe naturally from a portfolio perspective, banks will be more able to buy bonds. But I think unless we address the larger trilemma that I spoke about, bond yields, I think, will continue to be range-bound and under pressure and subject to a lot of uncertainty.
Just a quick follow-up. In the conference that you guys had in October, if I'm not wrong, a lot of your global peers, the people who you work with in JPMorgan, had come and said that they were hoping for these bond limits for foreigners to open up because they virtually come to a standstill after a euphoria in the first half of the fiscal year 17. What's the status there? And if it opens up, if it's not only already opened up, will we see buyers coming in as well?
So I think there are two limits here. There's a general limit, there's a special limit. One can argue that the special limit is not full. I think policymakers are understandably cautious about this. We just spoke about all the global uncertainty, all the global volatility. What you don't want is a big increase in the general limit such that there are capital inflows now and then there are outflows later, exacerbating volatility. I think one thing that policymakers can perhaps consider is there are a lot of real money investors in India who want to be invested in India for the long term, who don't technically qualify for the general limit. So maybe one prudent measure is to broaden the definition of the special limit, which is now open to sovereign wealth funds and central banks. If we can broaden that definition, what you could do is strike a balance between getting the real money flow, so to speak, the sticky money in India, and at the same time not exposing the economy to too much volatility. But I think policymakers probably would be considering all these measures to ensure that the borrowing programs goes through.